Who caused this? May 6, 2010, the U.S. stock market is in freefall. $1 trillion vanishes in minutes. Stocks plunge to pennies. Wall Street has no answer. When investigators trace the flash crash to its source, the trail doesn't lead to a trading floor or hedge fund. It leads to a bedroom in a quiet London house. What they find there shakes everything the financial world thought it understood. On May 6, 2010, global markets are already on edge. European sovereign debt concerns, particularly in Greece, have dragged index futures down 4% by morning. Underneath the surface, market liquidity is quietly draining away. At exactly 2:32 p.m. Eastern Time, something changes. A massive wave of selling floods the Chicago electronic markets. In an instant, the friction that normally keeps prices orderly vanishes. What follows is 15 minutes of absolute chaos. Between 2:41 and 2:44 p.m., trading volume explodes as computerized systems trade contracts back and forth in a blind panic. Major stocks plunge to pennies. By 2:47 p.m., the Dow Jones Industrial Average has plummeted 998.5 points, a historic 9% drop. $1 trillion of American market value disappears, only to mostly return minutes later as the market stabilizes. Regulators and Wall Street firms are left in disbelief, later calling it an extraordinary market event. No one can explain how the system broke so fast. To find the answer, investigators would have to look past the panic and peer directly into the electronic order book. The digital trail in the Chicago order books led away from the glass towers of Wall Street, crossing the Atlantic to Hounslow, a quiet suburb in West London. Inside a modest semi-detached house directly under the flight path of Heathrow Airport, a self-taught trader sat at a single personal computer in a small bedroom. This young man held an engineering degree from Brunel University and had briefly worked at Futex, a local proprietary firm, before striking out alone. Using a standard internet connection, he accessed the Chicago Mercantile Exchange remotely, bypassing the physical barriers of high finance. He operated without institutional backing or massive server rooms. Yet from this quiet suburban corner, his electronic orders traveled thousands of miles instantly, challenging the assumption that market power required massive physical scale. Investigators had found their location, but the operator's identity remained a mystery. To understand how a suburban bedroom could shake global finance, investigators had to dissect a trading strategy known as spoofing. In an orderly market, an order represents a genuine willingness to buy or sell. Spoofing is a digital head fake. A trader places an exceptionally large, visible order to create false supply or demand. High-frequency algorithms, programmed to react to visible order book data in milliseconds, see this massive block and quickly scramble, pushing prices in the direction the spoofer wants. Meanwhile, the spoofer places a smaller, genuine trade on the opposite side to benefit from the price movement. Before the massive fake order can be executed, it is instantly canceled. While canceling orders is a routine, legal part of electronic trading, doing so with the premeditated intent to never execute them is illegal. The key question was whether the London orders exceeded ordinary behavior to deliberately mislead the market. The focus centered on near-month E-mini S and P500 futures, a highly liquid contract used to hedge against or bet on the broader U.S. equity system. On May 6th, time-stamped records showed massive, alleged sell-side spoof orders appearing and disappearing in the E-mini book near the critical interval of the crash. Some regulatory estimates suggested these orders accounted for roughly 1/5 of all sell orders during the most intense period. Yet the data also revealed a massive competing force. At the documented start of the plunge, a large automated sell program entered the market. An institutional firm launched an algorithm to sell 75,000 E-mini contracts, valued at $4.1 billion under a preset 9% participation rate. During this chaotic interval, approximately 140,000 contracts were traded. High-frequency traders initially absorbed the volume, but as conditions deteriorated, they withdrew their liquidity, triggering a feedback loop of automated stop-loss orders. This created a deep division. Prosecutors argued the London traders' spoofing caused an extreme order book imbalance that helped trigger the crash, but independent analysts point to a fragile, automated market structure overwhelmed by a legitimate multi-billion-dollar sell program. Whether the bedroom trader broke the market or simply exploited its pre-existing cracks remains a subject of intense debate. Investigators parsing the E-mini order logs needed to trace the digital crumbs back to a physical machine. Working with detailed electronic records supplied by an anonymous whistleblower, they mapped the exact timestamps of the massive phantom sell orders. Every microsecond level coordinate pointed to a single electronic connection routing directly into the Chicago Mercantile Exchange. By matching the routing data to specific account details, they bypassed the complex web of automated systems and found a single name: Navinder Singh Sarao. Instead of a Wall Street executive, billionaire hedge fund manager, or head of a major financial firm, they had identified a self-taught trader working out of a modest suburban home. This connection proved ownership of the account, setting off a legal battle over whether his actions truly broke the global market. In April 2015, 5 years after the crash, British police arrested Sarao at his Hounslow home. A 22-count U.S. indictment accused him of wire fraud, commodities fraud, and market manipulation. After fighting a year-long extradition battle on £5 million bail, he was transferred to Chicago in late 2016. Days later, Sarao pleaded guilty to 1 count of wire fraud and 1 count of spoofing. He agreed to cooperate with federal investigators and forfeit $12.8 million, while civil regulators hit him with another $25.7 million penalty. The criminal outcome shocked the financial world. In 2020, a federal judge sentenced Sarao to time served and just 1 year of home confinement. The ruling established his illegal trades, but left the question of who actually caused the crash completely open. In modern markets, computerized order books display the visible supply and demand. Automated trading systems scan these cues in microseconds. When a massive block of sell orders appears, even a fake one, algorithms interpret it as an incoming wave of selling. To protect themselves, these systems react instantly. They lower their bids, pull back their capital, or join the selling. This triggers a domino effect. One computer sells, prompting another to adjust, which forces a third to completely withdraw. The apparent wall of liquidity vanishes in an eye blink. What remains is a hollowed-out market where even a modest trade can cause prices to crater. This is not a simple story of one bad actor. It is a structural loop where speed-driven algorithms supply, remove, and reposition liquidity in milliseconds. In this fragile system, the London trader might have filled one of 3 roles: the primary spark, a minor accelerant, or just a clever player exploiting a system already designed to crack. Regulators responded by rebuilding the market's safety nets. They established market-wide circuit breakers to pause trading if the S&P 500 drops 7, 13, or 20%. They introduced limit up, limit down bans to freeze runaway individual stocks, and stepped up algorithmic monitoring. These tools are built to slow down a panicked system, yet they do not eliminate the underlying nature of automated markets. The official joint reports from the SEC and CFTC carefully separated order book liquidity failures from a simple blame game, refusing to state that high-frequency trading alone caused the crash. And yet, when the dust settled, only one real person faced criminal prosecution. This leaves a stark contrast: a single, self-taught trader in his bedroom set against a vast, distributed network of exchanges, algorithm writers, and automated risk systems. If the market is structured in a way that it can destabilize itself without any human directing it, the mystery remains. Wait, was this man really responsible for the flash crash? Or was he simply the easiest person to blame? Today, the algorithms ruling Wall Street are faster and more complex than ever. The system remains a house of cards, waiting for the next accidental spark. If the technology itself is unstable, the next collapse won't need a scapegoat. Share your thoughts in the comments below.